After 5 years and hundreds of trades, I've discovered that every massive stock winner like Nvidia's 200% move follows these three exact patterns that most traders completely miss. One, they must be in a favorable market. Two, they are in a strong industry or sector. Three, they have a good technical pattern. Today I'm revealing three stocks showing these exact same signals right now, and I'll show you precisely why their setups look so promising and give you the exact entry and exit points to maximize your potential profits. Everything I will talk about is summarized on the Profit Punch website. So if you want the complete system that finds winners like Nvidia, which did 200%, Appfolio 350%, SMCI 250%, using just 1 hour of your time every week, you can find the full guide linked in the description below. Today, we'll be looking into Argentina stocks. Now, the USA market might be crashing, but not all stocks in the USA market are stocks of USA companies. So, there's some companies which are on the USA stock market, but they have holdings in Argentinian companies. So, the Argentina stock market is showing very bullish signs. Those stocks are going to go up. That's why they're in a good market, despite the fact that the primary USA market is bad. So here we do have a weekly chart and a daily chart. On the weekly chart, I do have the 10-week and the 30-week simple moving averages. These are all you need. On the daily chart, I have the 20 exponential moving average and the 50-day simple moving average. These are guidelines that I use to know whether I should be in or out of a stock. So the first one that I really like is called SUPV. So let's see what SUPV did in the past. Okay, so if we focus on the daily chart, let's see. We do have a big cup and handle here. And this consolidation is taking a very long time. So we can measure the length here in weeks. It is taking about 21 weeks. This is a very good length. Whenever stocks form a base which is more than 12 weeks, 10 to 12 weeks, anything greater than that, normally very big moves come from that. So cup and handle, very basic pattern. How would you have known that it's a very good time to buy? If you look at the Argentina ETF, ARGT, it was forming a cup and handle at the same time. So every Argentina stock was doing the same thing. If we look at BMA, same thing. YPF, same thing. And they all had 100% of moves. So we go back to our SUPV, same thing. So you can see that these stocks, they all have very similar moves. That's why you can profit, because if you see three of them all showing the same thing, it is a very safe time to get in. So cup and handle, very nice pattern for swing traders. You could have profited from this 40% move, and then you could have gotten in here again for the big move. How could you have known? Because when the simple moving average is falling down, normally stocks don't just run through it. Normally what happens is that they will come and try to form some sort of chit here, a handle, which is this handle here, and then I thought this was going to be the breakout, but it wasn't. It went and then it faked out and then it came and resetted. Because whenever stocks break out of their bases, which is this very big consolidation, three things can happen. It can either break out and fail, which is what we don't want. It can break up and just go, like here, it just went. Or it normally breaks out and then comes back and resets. So what happened here is that it came back and resetted for SUPV. So the correct buy point, the best buy point, was on this day. The good thing about these buy points is that they are not very confusing. Once a stock goes above that buy point, it never recovers. And that's why I normally use this as my risk, because I know that very good stocks should not come back. So if you bought here at the really good buy point, your risk should have just been below the confirmation candle, which is about 5%. So you risk 5% for a maximum potential profit of 140%. Of course, I don't think you're going to get that, since it respected the 20-day simple moving average for at least 7 weeks. I would have sold right here. So 18 times my risk back. So if I risk $100, I get $1,800 back from the trade. Very good profit. If I risk $1,000, I get $18,000 back from the trade. That's why I like risk to reward ratios. So you didn't have any reason to sell. Formed this very big move. And then right now it's forming a consolidation again. So if we look in terms of time, this consolidation is about 10 weeks. Currently, 9 weeks. Stocks don't just run over a falling 50-day simple moving average. Most times what happens is that they will run up and come from this kind of chit. And after that, they will break out. So after that breakout, it could reset or it could just go. So right now, if I'd set a position here, I would actually first wait for the price to move above the high of this candle. And if it's a valid move, the price should not come below this confirmation candle. So that is what I use as my law. If you're a swing trader, then you just want to swing and make a very quick profit. I don't think it would escape the base. I would say something around here. Maybe something about a 20% move or a 30% move. And then it's likely to form a chit after that. So if you're a long-term trader, then you're expecting that chit and then a breakout, or it could just collapse from there. So swing trader is the safest place to be. Wait for the high, you know where your risk is. You can get 4.8 times your money back. The next one that I really like is also Argentina stock. So same thing that happened last time. If we look, very similar pattern to the one before. Cap and then a handle, as we expect. First time to buy was around here. Why? Because we see this shakeout. This is the price shakeout. So what normally happens is that people who have very big positions, they can shake out people to try to get a stock lower for themselves because they know what is going to happen. But of course, you would be safe if you looked at the weekly chart and you saw that the 30-week simple moving average is still sloping up. And as soon as it moves down here and then it recovers immediately, first position to buy was up here at $28. As soon as it moves above the high of that candle, your risk is about 4%. As I told you, you can first swing trade it to the top of the base, so risk 4% to get 25%. Or if you're a long-term trader, you're just waiting for it to break out of the base, and this is like your first testing of the position. So after that forms a nice cup and handle. This is our breakout confirmation candle. As I said, we don't want it to come back. So we do have our chit here. Now let's focus on the daily chart. We do have our chit here, and then as soon as it breaks out of that chit, since it's a very large base, it's taking more than 12 weeks, then we just wait for it close under the 20-day simple moving average. So I'd have sold maybe around here, 85%. Risk would have been about 4%. If you got in late, let's say you just saw it on this day, which is what most people are going to do, then my risk would just be below the low of this candle. So 9% risk, make a 90% maximum gain, most likely going to get a 70% gain. I guess question could be, why didn't you sell on this break here? Three things why. Normally, I will wait for at least maybe a 3 to 4% break of the 20-day simple moving average. That's the first thing. And if we measure this, I think it was just 3.5%, right? Which is very small. So even if I sold here, if it recovered immediately, I would have bought back. So I don't count that one. Why would I have bought back? Because if I look at other stocks in the same industry, YPF, they were all just around that same day. They were all showing okay moves. If I look at SUPV around that same time, they were all just recovering. So after they all recovered, then I'm like, I should just go back into this stock. So ideally, you buy here, the breakout maximum move is 100%. Of course, I don't think we're going to get all of that. It would have gotten out above about 80%. So same thing is happening in the base. It has been collapsing. If we look at the weekly chart, it has been, the base is about 9 weeks, 10 weeks. Yeah, 9 weeks, 9 bars on the weekly chart. We see the first close above the 20-day simple moving average. If we look at these candles closely here on the daily chart, you can see that it has been bottoming out here. So you can see this kind of like double bottom closes above. So this is what I like to call a confirmation candle. So what I would do is that I would only buy if it moves above the high of that candle. My risk is the low of that candle. So I'm just having about a 4% risk, and I'm expecting about a 24% move. I don't think it's going to exceed the base because it's very deep in the base. The best handles are just midway the base. So this is very deep. So I don't think it's just going to escape and run up. It's most likely going to form a cheat, or it could just come and then just crash forever. I'm not sure right now, but this is still a very good opportunity. As a swing trader, you know what to do. There's something called also the 3 green days. If I see 3 green days in a row, 3 green days that happen in a span of at least 6 days maximum, then if the price moves above the 3rd green day, I can normally buy above that high. And each green day must be closing above the high of the previous green day. So green day 1, this green day closes above the high of the previous day, then we have a red day, then we have a 3rd green day which closes above the high of this day. So I like this very simple pattern. You can see it happen everywhere. So also here, 3 green days. So here was 3 green days. It could have been faked out. Here was 3 green days, but they did not happen within the candle count that we're looking for. So you wouldn't have gotten in here, and also it didn't close above the 20-day simple moving average. So anyway, That's also another signal that I use. But the reason why this one is a little bit stronger compared to this one here is that here we can see that it's forming this support here. So we're expecting it to go up. It could just go up, it could fail, not sure, but keep the risk very tight, get a swing trade, make your profit. The next one and the last one is YPF, also Argentina stock. So this is what is quite interesting. All these stocks, since they're from the same industry and stuff, they are all forming very similar patterns. So if we go back, see that same cup and handle that was in all the others. This one was a little bit more tricky, right? So here I was just showing the swing trades you could have gotten if you are a swing trader, but if you're a long-term trader, these were like just shaking you out. So it wasn't fun to be in this one. So the first one was about here, recovers from this cup and handle, looks like it's breaking out, fails. Then the second time it breaks out is here. So this is a very nice one. As a long-term trader, you could have gotten in here and you could have gone for your about 90% move, should I say? 100% move? Yep. Because after that, it didn't close under the 20-day simple moving average for a while. So you could have gotten out here. Then it forms this cheat again. Remember, like I told you, we like to see very small cheats. If a cheat is normally under 10%, it's always perfect. This one I'm sure is under that. Yeah, 7% cheat. Very nice. That's the last time you can buy. It's telling you we gotta go buy now, buy now. So as soon as you buy there, get your nice profit. Risk shouldn't come back down. So you keep these very tight risks. Risk about only 0.4% of your account. If the trade goes against you, you're not losing very huge money. But if it goes in your favor, you can see how you can make these very big wins. So let's say this one, if you got in at the right time and risked about 3.8%, maximum potential profit was 28 times your risk. I don't think you're going to get that. Most likely you'd get this on 23 times your risks back. So that's about 23 times 0.4. If I'm just to say 0.5, you're getting about 11% of your account just on one trade. And that could be even your yearly returns. If you get like 2 of these trades because you saw the industry moving, pick up 2 stocks, that means you got 22% of your account, profit from just this one really good move. Yet you risked only 0.8% of your account. That's why these moves are very profitable and can move mountains. If you like this content, please subscribe to the channel. Check out the newsletter if you want alerts, because I always look at the markets whenever these happen. I alert my newsletter. So you want to sign up for that. With that being said, may the markets be with you.